Hello, I'm Udayan Mukherjee, and today we start at a very basic point. How do you choose a good stock and how do you know a good stock from a bad stock? Now, this discussion can go on for hours, so I've chosen only a few, 5 or 6 key metrics which you should be looking at in determining whether you're going into a good stock or not such a good stock. There are many more, and this is an oversimplification, but you start with industry leadership. Basically, over the years, it has always been true that the leaders in any sector make money, make the most money. That is not to say that only the number one stock in a sector can make money. Usually, you look at the number one company or the number two company, the leader and the challenger. Sometimes the challenger grows faster than the leader because it's gaining market share. So, you basically look at the market share dynamics in every sector. You say this company 1 has 40% market share, the company 2 has 25% market share, and between the two of them, they have 2/3 of the market share in a particular sector. The rest of the sector is very fragmented, and I do not want to get into that space. What happens with industry leaders is, because of their superior sales and profits, they begin to create moats around themselves. What are moats? You've seen fortresses, and they surround themselves with water so that others cannot get onto their turf. And companies who are successful and leaders in their sector often use their superior cash flow to create different kinds of moats around them, which are sometimes technological in nature and sometimes other strategic in nature. So look out for industry leaders in every sector. Industry leaders are not very difficult to find. Like in technology, you will have TCS and Infosys are the leaders. You look at banks, you will have ICICI Bank, HDFC Bank, Kotak Mahindra Bank as leaders. And those are the ones that you should be focusing on because they have demonstrated over a large period of time superior market share characteristics. Now, what kind of sector should you be looking at? Because it's not enough just to look at a company in isolation. The sector plays a very important role in determining whether you will make wealth or create wealth from the sectors. Generally, though this is not always true, try to not get into very cyclical sectors, deep cyclical sectors. What are cyclical sectors? Where profits are good in some years and in some years profits are very bad. So they go through cycles of 4 good years and 4 or 5 bad years, then 4 good years. And overall, after the long period of time, over a 10-year period, you'll find that after going through many cycles, you're not making more than, on an average, not making more than 8-10% kind of return. And therefore, these generally tend to be not long-term wealth creators. What kind of sectors are cyclical? Metals, autos, even capital goods. So be very careful when you're getting into stocks into cyclical sectors. However, there is a caveat, because for some years when the going is good, when you're actually buying metal companies or capital good companies or auto companies or airline companies in an upcycle, you can make a lot of money. But that is more tactical in nature. You have to be very much on the ball. You must know when to get in and when to get out. These are not buy and forget kind of stocks that you buy and then forget for 15 years and then you make a lot of money. Generally, they need to be tactical, which is that you get in, you make a bit of money and then you get out. And it's easier said than done, and therefore you need to be very, very vigilant. Now, what kind of sectors should you be looking at? These are good companies usually belong to secular growth sectors. What are secular growth sectors? Where there is a consistent growth year after year after year after year, so that your wealth keeps on compounding. Generally, they belong to sectors like consumption-oriented sectors, so consumer sectors, consumer products, durables, non-durables. Why? Because while the economy goes through cycles, many of these sectors actually do not go through such violent ups and downs. So in some years, profits will be greater than others, but the peak and the trough are not as disparate as in company sectors like metals, auto, or airlines. So keep your eye on the good sectors to buy into and try and avoid some of these deep cyclical sectors. Then you must look at the balance sheet of the company. You must choose companies which are not overloaded with debt. So once you have made up your mind that sector A is the one that I'm going to get into, and in sector A, I'm going to look at stocks X and Y because they are market leaders or challengers, number 1 and number 2. And then you need to start looking at the micro analysis of those companies in that sector. And you start by looking at the balance sheet and you say, I want to have a low gearing, which is the low debt equity ratio, meaning I don't want to get into a company which goes bankrupt or folds up in 3 years' time because they could not repay their debt. The higher the debt equity ratio, the stock market will start punishing this company. And if the interest coverage ratio is very low, which is that the company is not able to cover or service its debt, then you will find that the stock will come under pressure. From the balance sheet, we move to the management. This is a very, very important part of evaluating a company, because good managements usually belong to companies which create shareholder value. And there are many ways to look at what is a good management. You look at the management's track record of declaring dividends, management's track record of distributing profits, management's track record of diluting their equity. How often do they keep raising capital? If they don't keep raising capital, then that's a good sign. How often have they sold their own stocks down? Managements which don't dilute their own equity holding in a company are usually strong managements. And you look out for instances of poor corporate governance where there have been any pull-ups from the market regulator SEBI in the past, any red flags, any adverse reports that you've seen on the management in the past. All of this should be a red cross in the box, and you should be very, very careful. The market usually punishes companies with poor managements, and you should be very wary about that. And you have to then look at the valuations of the company. You look at the PE multiple, and you don't want to pay too high a PE multiple for the company. PE multiples in the zone of 15 to 20 are generally good. You don't want to be paying 100 PE for companies, and you want to see if the company is generating return on equity of say 16, 17, 18%, and better still above 20%. So those are usually companies which end up creating value for you. So look at the past track record of the company. What is the kind of return ratios over the last 4 or 5 years? Return on equity, return on net worth. What is the kind of growth in profits and margins the company is showing? These are very, very important to monitor. And then you drill down to the debt, to the management quality, and you start off always by looking at the sector profile and the market leadership or the market position profile of the company. If you do all of this, chances are you will end up with a company which creates a lot of wealth for you in the years to come, and then you want to hold on patiently with this company till something goes wrong.
If you like the video, do like, comment, share and subscribe.